And joining us now on the debate in Washington, D.C., Joseph Gagnon, Senior Fellow at the Peterson Institute for International Economics. In Pittsburgh, Pennsylvania, Alan Meltzer, Professor of Economics at Carnegie Mellon's Tepper School of Business. And here in studio, Brian Milner, Senior Economics Writer and Global Markets Columnist for the Globe and Mail. Welcome, everybody, in Points Beyond in the United States. Brian, nice to have you back on the program as well. As we suggested off the top, this is a program designed to get towards the inner economist in all of us. I don't have to tell all three of you that this is a program that I don't think necessarily people are talking about at water coolers across North America, but it's a hugely important topic, and that's why we're doing it. So, Joseph Gagnon, to you first. Let's just get the definition out there. Some people in the financial world are talking about QE2, and they're not talking about a boat owned by the Queen. They're talking about quantitative easing, the second round. What does it mean?
Well, what it means is that the Federal Reserve feels that it's not achieving its objectives of stable prices and maximum employment. Unemployment's too high and inflation is too low. So they're trying to stimulate the economy. And the way they're doing that is, as you said, by printing money to buy longer-term bonds. As you know, though, a normal procedure for the Federal Reserve is to guide the short-term interest rate, but that's at zero. It can't go any lower. So what they have to do is guide longer-term interest rates lower, and that's what they're trying to do.
Now, Alan Meltzer, this is, as we said, QE2, meaning they've done it once already. What happened the first time they tried it?
Very little. Very little. They prevented perhaps a collapse in some of the banking system. That's to the good. But it didn't stimulate the housing market, even though they bought $1 trillion worth of housing securities. And it certainly didn't reduce the unemployment rate because it's still as high or higher than it was when they started. So, and this one is going to have exactly the same result. Nothing.
Well, if QE1 didn't work, what makes them think, not you think, but what makes them think, Alan, that QE2 will work?
Well, they is a mixed group of people, some of whom do not think it's going to work, and really told the chairman that he was on the wrong track. But the chairman is insisting upon this policy because he's doing what the Federal Reserve has done over and over and over again. That is, it's overreacting to short-term changes. The economy looked to be slowing in the summer. People on Wall Street started to say something about double-dip recession, another recession. That was a short-term problem. It's gone away. The economy isn't booming, but it's doing better in the fall. So the policy was aimed at something that really hadn't happened. That's not the first time they've made that mistake. That's the mistake that they traditionally make.
Joseph, you wanted to come back in?
Yes, I guess here's where I would disagree with Alan. When they did quantitative easing in the first round, we actually had a small boom of mortgage refinancing. People took advantage of the lower long-term interest rates to refinance their mortgages. Now, not as much as they would have liked, but quite a bit. Those households now have lowered their interest rates permanently, and that's money that they can spend to boost the economy or get their household in order, so they'll feel better about the economy. Businesses, similarly, had a record-breaking issuance of corporate bonds in the wake of the quantitative easing one, which enabled business investment to be the strongest component of the recovery. So I think it has had an effect, but perhaps not as much as the Fed would like. I do agree with that.
Alan, you want to come back on that?
Well, yes, the housing problem is one where they're making a mistake. I mean, the fact is that if they hold up the fall in house prices, they delay the solution to the housing problem. House prices have to fall, and by doing various kinds of stimulus, they prevent that. So they're getting a short-term advantage, but not a long-term benefit. In fact, they're getting a long-term loss. We still have to go through the process in which housing prices, unfortunately, have to fall to reach an equilibrium at which there will be a market demand for housing much stronger than the one there is now.
Okay, let me get Brian Milner in at this point. You know, the conventional wisdom has always been you don't print lots of more money because that devalues the currency and that'll cause inflation. But apparently, the United States Federal Reserve is not that worried about inflation right now because they just did $600 billion worth of printing, basically, a week or so ago. Why are they not so worried about inflation these days?
Well, first of all, $600 billion in the U.S. context is not a lot of money. It's a drop in the bucket. It's not even 4% of GDP. So it's not a lot, number one. Number two, inflation has been low, historically low. It's only around 1% if you strip out the usual energy and food, which is always going to be higher anyway. So essentially, they're looking at not necessarily deflation yet, but certainly disinflation, and that's the fear. The Fed's job...
What is that? Just explain that before we go further.
Disinflation means that there's no inflation in the economy, which means there's basically no demand. There's no prices are not moving up. Deflation is when things actually fall and people put off purchases because they expect prices to actually be lower. They're sort of right flat at the moment.
And in the best of all possible worlds, what do you want?
You want roughly 2 to 2.5% inflation, which is a Canadian target. You want to see a little bit of inflation. That's how you promote growth in an economy. And that's what most central banks look for. There are arguments that in the U.S. they should be looking for even higher inflation than that to make up for the very low inflation they've had before, and that they should have a target now of, say, 4% inflation to make up for the fact that it's been below 2 for so long.
Okay, Joseph Gagnon, come in here then and tell us why it seems...
I disagree with most of that.
Oh, all right.
I disagree with
my
most
God, I
of
didn't
that.
have him
Alan,
teaching.
Alan, you go. Brian Milner is expressing gratitude that he didn't have you as a professor when he went to university, but come on in here and straighten him out anyway.
It's a pity he didn't. First of all, sure, $600 billion is not a large amount of money for the U.S. economy, but it's a large amount relative to the excess reserves. We already have $1 trillion worth of excess reserves. We have more than $1 trillion on the balance sheet of banks. What reason could anyone in his right mind have to believe that by adding $600 billion more that we're going to do something important? Now, what are we going to do? Well, we got interest rates to go down on the announcement that they were going to do this, but now they're higher than they were when Mr. Bernanke spoke at Jackson Hole. So that part of the program hasn't worked, at least not so far. The dollar has weakened. It's strengthened a little bit now, but not because of strength in the U.S. economy, but because of problems in the European central bank. So those things, decline in the dollar, raises consumer prices because it raises import prices. Cotton prices, almost all agricultural products, they're all going up. They're tied to the dollar. Energy prices, tied to the dollar, they're going up. So it's not true that prices are low, first of all. And second, the Fed's target is 1 to 2% on the inflation rate. And that's where it's been.
Okay,
so in order to get people convinced that maybe he was doing something, about disinflation or deflation, Mr. Bernanke changed the way in which the Fed measures inflation without telling people that that's what he was doing. That seems to me to be a bit of sleight of hand that we shouldn't expect from our central banks.
Okay, the professor has spoken. The student gets a chance to reply.
Well, we do hear this argument all the time. The main critique of the Bernanke plan is that it's going to bring on inflation. I hear this all the time. The problem is that you don't get inflation in this scenario unless it actually works. So you can't say it's not going to work and it's going to be inflationary. It can only be one or the other.
Joseph, you want to come in on that?
Yes, please. Yeah, sure. I don't know. There's too many things to say here. I guess I find myself more in agreement with Brian, but I think, to me, the problem is that they're probably not being aggressive enough. I think on the inflation target, that 12 of the 17 members of the FOMC have said they want 2%. So that's an overwhelming majority that say they want 2% inflation. I think if that's what they want, they're getting 1% now. They would like to have more, and they also would like to get unemployment down. I think what they've done has helped a little bit, but it's not really enough. It's not what the economy needs. And it's not just in response to very short-term changes. I mean, the forecast for the U.S. economy has been sort of below par for a long time, and it's not expected to get better for a long time. I think I would agree with Professor Meltzer if things were going to be better, expected to be better soon, then you wouldn't want to do this because of all the lags. But the fact is no one's expecting the U.S. economy to get back to potential or inflation to get back above 2. for 3 years or more. That's just too long.
Joseph, let me follow up. I want to make sure I understand what you're saying when you said they weren't being aggressive enough. Do you mean they should have spent more than $600 billion in their QE2, their quantitative easing, second round?
Yeah, I think $2 trillion would have been a good start.
$2 trillion?
Yes.
Okay. Professor,
this is not...
let me get, I should get Alan Meltzer to comment on that. $2 trillion they should have spent. What do you say to that?
I say absolutely crazy. I mean, it's true that the economy is weak, but the reason it's weak has nothing to do with the absence of monetary stimulus. We have more than $1 trillion. Before they began, we had more than $1 trillion worth of excess reserves. Anybody who wants to borrow and has a good chance of being able to repay can get a loan. There isn't a shortage of liquidity. People who are very much in favor of this, like Larry Meyer, a former Fed governor who runs a very prominent consulting outfit, his forecast for next year, based upon the assumption that there would be not $600 billion, but $1.5 trillion worth of stimulus, raises the growth rate by 0.3%. Hardly worth the risk that we'll have an inflation. Now, the inflation isn't going to come tomorrow, and it's not going to come next year. But it does raise the question of how is the Fed going to reduce the 1.6 or more trillion dollars worth of excess reserves? We've never had that before. They don't have a plan for doing it. They talk as if they did have a plan, but they don't have a plan, and they don't have a way of doing it. And it's sort of, trust me, I'll do the right thing when the time comes. Well, their record of doing the wrong thing most of the time is pretty good.
I've got to get Brian Milner here to play umpire, because on the one hand, Joseph Gagnon is saying $2 trillion as a QE3, I guess, and Alan Meltzer saying this is a big waste of time, it's not going to achieve anything. Have you got a number that's that you think is preferable?
In between? Well, I've heard all of those numbers, of course. The $600 billion is considered the small end of things, if you think this approach would work. I would sort of be in the middle and say it won't work, but they have to do it anyway.
It won't work, but they have to do it.
That's right.
Why do they have to do it if it won't work?
Because that's their job. Their job, they have the oddest mandate of any central bank in the world. Their job is to grow the economy, create employment, get employment higher, and have stable monetary regime. In other words, stable inflation. And they need to work on both. This is the last tool they have left, because as we've heard, short-term interest rates are at zero. They're effectively below zero. So this is what they have left to do. It could work if it were combined with a change in fiscal policies, with changes in tax regimes, all the stuff that Congress would have to do and that they're not going to be able to do because of political gridlock in Washington.
All right, let me get Alan Meltzer to talk about this for a second, because remember, you're talking to a Canadian audience here that that may not be steeped in the legislation that was passed, I guess, back in 1930 on what exactly the Fed's role is supposed to be. So, given that the Fed is supposed to ensure stable prices, low unemployment, and security of the financial system, would you put those into a hierarchy and tell us what you believe their prime task ought to be, and then in descending order what the other things are?
Yes, their prime task is congressionally mandated to achieve stable inflation, low and stable inflation, along with full employment. So the question is, can they do that? And how can they do that? Well, in the present context, they can't do it by printing money, because we don't have a monetary shortage. We have a huge excess supply of reserves. What could the government do if it wanted to improve things? Now, I have testified in Congress, and both Democrats and Republicans agreed with me, but the administration hasn't done anything. What it should do, in my opinion, is remove the uncertainty which its mistaken policies have created. Businessmen, when you talk to them, when congressmen talked to them during the election campaign, businessmen told them, we don't know what the tax rate is going to be, we don't know what the energy costs are going to be, we don't know what healthcare costs are going to be, we don't know what new regulations are coming. So my proposal is have a moratorium on tax increases and regulation for 3 years, except in the case of national security. That would give some certainty about the near-term environment and would help people to begin to do things. Now, the long-term problem is a long-term problem. That is, much of the reason for low improvements in employment is that much of the unemployment is concentrated in industries like housing, which is a big employment industry. And we're not going to build houses no matter what the government does in the near term, because we have such a big excess supply of housing, and the government has a policy of trying to keep prices from falling to their equilibrium level. So that problem is going to go on. And there's a wonderful, excellent book by Reinhardt and Rogoff, which tells you that in over 200 years, whenever we've had this problem, it's taken a long time to get it resolved. And that's going to happen now, and there isn't a lot that we can do to change that. We can improve things by putting a moratorium on regulation and tax increases, but it won't solve the problem.
In fact, we've had Reinhardt and Rogoff on this program talking about that book, and I think they actually go back 8 centuries, not just a couple of centuries. But let me get Joseph Gagnon to speak about this. It sounds like, if I understood Alan Meltzer properly, that he believes the problem right now is more political, as in the solution is on something that Capitol Hill and the administration can tackle, as opposed to something the Fed ought to be doing. What's your view on that?
Well, I would like to have more fiscal stimulus, but I think that's not going to happen. I don't think this view of uncertainty, surveys of what businesses care about right now do not put uncertainty even in the top 5 issues. Overwhelmingly, it's lack of demand for their products, lack of sales. That's what we need to get spending going. And that's what monetary policy is geared at. Now, we all noted how interest rates at the short rate are at 0. But the textbooks don't really talk about monetary policy only being on the short rate. I mean, we have interest rate, but there's many interest rates, and there are other interest rates that can be pulled down. By printing money to buy longer-term bonds, other assets, we can bring their rates of return down. That will stimulate spending. We know it's worked in the past. I see no reason why it should not work now.
Okay, Brian, let me try this with you, because I think one of the things we need to better understand is how these decisions get made. This is a decision that was announced by the United States Federal Reserve. Does that mean that Ben Bernanke, the chairman, made this decision?
Well, he certainly would have led the discussion, but this is a decision made by the Federal Open Markets Committee, which sets monetary policy. And I think it's 17 members now in that committee. And there pretty much has to be agreement. Now, there was one dissenter of the 17, and he's a long-term dissenter. It's the head of the 18, thank you. He's the head of the Kansas City Federal Reserve Bank, and he has opposed everything the Fed has been doing over the last year.
We should just remind everybody, there's one central Fed in Washington, and then, of course, a lot of big cities in the States
12 regional
have
banks,
regional ones.
But not all of them sit on that policymaking committee. This year, they rotate. He's the only opponent of those policies who happens to be from the regional Fed on that committee. But there are other regional presidents who also disagree with this entire strategy.
But tell me this then, is this a decision that would be made strictly within, if I can put it this way, the fiscal walls of the Fed, or do people in the Obama administration lobby the Fed to do this, or try to convince them not to do this? How much politics is involved in this decision?
It's supposed to be an independent arm's length decision, and Bernanke has stressed, in fact, that this is the case, and that, in fact, if the Fed were doing something else, if they were to curtail this plan now, given the political opposition that's arisen to it in the Republican ranks, then that would be a political decision.
Now, Alan Meltzer, can you comment on that? How independently do you believe the Fed is acting on this, or are they swayed by the administration at all?
Well, independence is a word that gets thrown around, but its meaning changes from time to time, and it was at its peak, that is, they were the most independent in the Volcker years, and they're not very independent at the moment. Mr. Bernanke has been doing fiscal operations for the Treasury. He's been buying, the Treasury announces that the Federal Reserve is going to buy $1 trillion worth of securities. Then the Federal Reserve announces it's going to buy $1 trillion worth of mortgage securities. I mean, that's hardly independent. So he has, quote, cooperated, end quote, with the administration to a fairly well, and that's been to the detriment of the Federal Reserve. So in this case, I'm sure that Mr. Geithner, the irrepressible Mr. Geithner, who told the Europeans and and Asians that the United States has a strong dollar policy. I mean, how much more could you mislead people than to say that you have a strong dollar policy when you're printing money to buy 600 billion? It's not, it is certainly true that they didn't print the money to devalue the dollar, but it's certainly true also that he had to know that if he doesn't know that, he shouldn't be Secretary of the Treasury, that if you print that much money, you're going to depreciate the dollar.
Do you think, Joseph Gagnon, that Tim Geithner intentionally misled people when he said that they weren't trying to devalue the dollar that way?
He did not intentionally mislead people because the Fed's actions were not aimed at the dollar. They were aimed at lowering U.S. Rates of interest. But he knows, as well as everyone knows, including Ben Bernanke,
but he told people
the side effect is that when interest rates in the U.S. are lower, investors some will move abroad into other currencies, looking for higher yield, and that will push the dollar down. Yes.
But he did tell people that he had a strong dollar policy. I mean, that's an out-and-out fabrication.
Every treasurer I've ever heard
and it's an embarrassment because no one would believe him.
But every Treasury Secretary is obliged to say that.
Absolutely, they all say it, and it's often not true. And if the dollar does end up being weaker, that's not necessarily to the detriment of the United States. It's to the detriment of the main trading partners who have been taking advantage of the United States all these years.
Okay, Joseph, let me get you to come in on this. QE2 is in effect. They have purchased the $600 billion worth of Treasury notes. They have tried to have a stimulative effect on the economy. How have the markets in the United States reacted to this effort?
Well, it's always tricky to assess this. I did a careful study of QE1, which was released a few months ago. But it's going to be harder to study QE2 because it was news about this policy has trickled out slowly. I would say it goes back to the beginning of August, when rumors started coming along that they would do it, and then the August FOMC meeting, and then speeches by the chairman through the month of August and into September. So it's very hard to put your finger on specifically what market move is because of this and what market move is because of other factors. My best estimate is that as of today, as of 2 hours ago, the 10-year bond yield is about 15 basis points lower, not much. But the 10-year real yield was about 40 basis points lower, which is something, which says that perhaps they're succeeding as much by getting inflation expectations back up to 2 as they are by lowering bond yields. But either way is fine as far as they're concerned.
Brian, how would you interpret the reaction of the markets?
Well, I think the markets did what we call pricing in the news. They did that earlier. They said, this is the effect we think it should have. And then they looked around and they saw the crisis in Europe erupting, and they saw all these other issues, and then they started worrying about inflation because so many important American economists, like Professor Melcher, said, you really should be worrying about inflation. Well, that's what's happening now. They're starting to worry about inflation. Let
me go to Professor Melcher then. And of course, we're very concerned these days about how people are reacting in China or Brazil, India. What have been the reactions in those emerging countries?
Well, the Germans have pursued a very different policy. Mr. Geithner told them that they should do what we're doing, but they're doing much better than we are because they're doing the opposite of what we're doing. They're pursuing a long-term strategy to try to rebalance the German economy and to export. That's a very good strategy. It's working for them. It's helping most of the rest of Europe. So the Chinese, of course, they follow the policy of keeping their exchange rate low. When our dollar devalues, the Chinese currency devalues right along with it. So if our policy is to get the Chinese to do better for us, this certainly is not helping. Although inflation in China is helping us because it's raising the real value of the Chinese currency. But the Chinese have complained about it. The Brazilians, a big exporter who want to see stability in the world, they complain about it. The Indians complain about it. The president went, and Mr. Geithner went to Seoul and tried to talk other countries into doing things that they would like, and they drew a blank. That is, most of them said, go peddle your papers somewhere else. So America's leadership in the world is in question, and properly so, because this administration is pursuing relatively poor policies domestically and internationally.
Let me get Joseph on this. I think it's fair to say, Secretary Geithner's comments about his strong currency policy notwithstanding, that many emerging markets are concerned that their economies are going to be flooded with cheap American dollars. And I wonder if you could tell us what you believe the consequences of that will be.
Well, the Federal Reserve's own models say, and other macro models too, it's not unique to the Federal Reserve, say that there are two effects here, and they roughly cancel out. And so it is true that there's some effect on the dollar, which the foreigners are complaining about. It's understandable. It's very visible. Their exporters are concerned. But to the extent that we've lowered and can lower real long-term rates in the U.S., raise the stock market, increase investment and consumption in the U.S., that will boost U.S. imports. And the models say that those two effects are roughly equal, so that the rest of the world is roughly unaffected by this. But of course, the second effect takes time, it's harder to see, whereas the dollar is very visible, it's easy to see, and that's led to all the criticism. But I think it's very unfair. It's generally accepted in international economics that countries are allowed to use domestic policies to achieve domestic growth and stable prices. And the U.S. is operating on domestic assets through a domestic policy. We are not buying foreign currencies the way many foreign countries do. So we actually are not engaging in aggressive actions the way many other countries are. So I think it's actually almost hypocritical of countries to complain when the U.S. is only doing domestic policy here, and the U.S. economy clearly needs the boost.
Brian, what do you say about that?
Well, I think that's quite right. And also the fact is that it's not universal, the criticism. The Indian Prime Minister at the end of President Obama's visit said that it's necessary for the U.S. economy to recover, and that a stronger U.S. economy is actually better for the world than a weaker U.S. economy and a stronger dollar. The issue is, will this work? I mean, that's the underlying problem here. For Canadians, we're also better off with a much stronger American economy. I mean, that's our biggest market. Meanwhile, the weaker U.S. dollar helps our commodities. So we benefit both ways, but we need it to work, and there's no indication that it can work on its own. Bernanke himself has said that without other policy responses, especially on the fiscal side, that this alone can't fix the problem.
Okay, Alan Meltzer, tell me that. Do you believe, I understand what you've had to say about Tim Geithner, and you're not, chairman of his fan club, I get that, but do you believe the Fed is deliberately seeking a weak dollar in order to aid American exports?
No. I think it knows that it's going to weaken the dollar, and of course it hasn't engaged in such hypocrisy, to use Mr. Gagnon's word, as to say, well, we have a strong dollar policy. They don't have a strong dollar policy. We have hardly ever had a strong dollar policy except for a time during the Clinton administration when productivity growth rose and the dollar strengthened. But, if you go back to 1971 when the Bretton Woods system effectively ended here, the Swiss franc was 4.3 to the dollar. It's now less than 1. The Japanese yen was 360 to the dollar. It's now about 85, 83. So that's hardly what you'd expect from a country that was following a strong dollar policy. The truth of the matter is, we don't much care about the exchange rate here.
Okay, let's do a kind of rosy scenario versus Armageddon, a bit of crystal ball gazing at the moment here. And Joseph, I'll go to you first. Finish this sentence in the way that you want to. Under a rosy scenario, in 1 to 3 years' time, quantitative easing, second round, QE2, will have helped achieve what? Fill in the blank.
If I'm allowed to say that they use quantitative easing as much as they need to, then we should get unemployment back down below 7% and inflation back up to 2% within 2 years or so. That would be my rosy scenario.
But that requires not $600 billion in spending, but more like $2 trillion. Is that right?
Yeah, I think probably $2 trillion, maybe more, but that's a good estimate.
Okay, but given that there's no indications I'm seeing so far that $2 trillion is on the books. 600 billion is what they're playing with right now, in which case, what do you see the impact of that being?
Oh, I think, you know, it pushes the unemployment rate a few tenths lower than it otherwise would be. It's going to fall anyway, but it's going to be in 2 years probably still above 8%, which is not good.
Okay, Alan Meltzer, let's get you to fill out the same scenario. Under the best possible circumstances, given the QE2 that's just taken place, over a 1 to 3 year period, what do you see as the impact?
Very little. That is, as far as the economy is concerned. And let me just say that if Mr. Gagnon's policy were ever adopted, the dollar would begin to fall drastically and the expected inflation rate would go up, because the Fed has no policy for getting rid of $1 trillion worth of excess reserves, so it has even less chance of getting rid of $3 trillion worth of excess reserves without creating a new inflation.
What do you think inflation would go to under those circumstances?
Oh, well above where it went in the 1970s. You know, we have experience not so long ago when the Fed pursued a policy. The people who were on the Open Market Committee at the time were not idiots. They would say to each other, to themselves and each other, we're not going to let inflation happen. We're not going to do this again. We're going to really stop the inflation as soon as it starts. And then the unemployment rate would get to 7% or more, and all that would be forgotten. And it was forgotten until Paul Volcker came along. And what he said was, well, people used to believe that they could trade off a little inflation for a little better unemployment, but we know that that's not so. And it's not so because both have risen. And that's the kind of mistake that he stopped and that Alan Greenspan kept from getting into again. And now we have the mistake of following a kind of policy which is going to lead us to a problem of inflation, a serious problem of inflation in 2 or 3 years.
Okay, Brian Milner, again, under the rosy scenario, stand by 1 second, Joseph, because I want to get Brian to come in on this first. Rosy scenario, 1 to 3 year time period. If things work out, QE2 will have begat what?
If it's just what we see, if it's just the 600 billion and there are no tax changes, there are no fiscal policy changes, and the private sector is pretty much doing what it's doing now, which is waiting for demand to pick up, then we're not going to see much change. We are going to see unemployment drop very slightly. The problem is that we're going to see an increase in part-time employment, so most of that improvement will be part-time jobs that aren't very secure. The reason the unemployment rate will drop anyway is that all these people who lost their jobs in, say, the housing sector are now in the middle of being retrained. And in 2 to 3 years, we'll see them back in the workforce doing something probably for a lot less money, but they will be working.
Or having dropped out of the workforce altogether.
Yes, and that's already happening. Yeah. The actual unemployment rate, if you include the underemployed, is around 17%.
Oof. Okay, Joseph, you wanted to say?
Well, just in response to Professor Meltzer, I certainly won't deny that the Federal Reserve has made mistakes in the past, and even as recently as 2004, 2005, when they were too slow to tighten. So I take his point. I mean, I could understand why someone would be worried that if they're too easy now, or if they're easy enough now, in my view, that will set up a too easy policy later. But there's no technical reason why that has to happen. They have the tools. They can actually do reverse repos against these. They can sell these assets. They can raise interest on reserves. They have too many tools, more than they need, to tighten when they need to. I guess the question, though, is, will they do it fast enough? That is a legitimate question.
Right.
And I want to reemphasize that this inflation is only a prospect if it actually works. And that's what the purpose of all this is. I mean, you want this to work. You want the economy to pick up. It's not inflationary if all this extra money is just sitting on the shelf. It needs to be at work in the economy for it to have a real inflationary impact.
Alan Meltzer, at what point will we know whether this QE2 worked?
Oh, probably in 6 months, we'll begin to see that it hasn't done very much. Let me just say, and remind some of the people who haven't studied the history as much as I have, from 1934 to 1937, we had never less than 15 to 20% unemployment rates. Prices rose 12%. You know, it doesn't take a boom in the economy to get the inflation going. It just has to come at a, people have to believe that we're printing money too fast, that faster than they want to increase their holdings of it, so they get rid of it. And that is beginning to happen in the dollar market, and it's going to spread to other markets slowly, but very definitely if we stay on this track.
That is the history, Brian, but can you overlearn the lessons of history?
Well, certainly the knock against Ben Bernanke is that his entire focus as an economic historian has been the Great Depression and what caused it. And of course, we now know that it was bad central banking policies that made it much worse than it could have been at the beginning of the 30s. And he has sworn to do everything possible on the other way. That doesn't mean that it will turn out to be right, because nobody knows. Nobody's really tried this method at this scale except the Japanese. And they say, well, look at Japan. They've had 20 years of deflation, even though they've done a lot of quantitative easing. But that's partly because the Japanese gave up on quantitative easing in 1997 and went back to much tighter money and choked off the economy again. Plus, their economy wasn't functioning very well to begin with.
Gentlemen, I want to thank all three of you for diving into a topic. I'm afraid we're out of time, Professor Meltzer. But would you promise to come back and we'll discuss QE3 when they do that?
Well, I'd like to discuss Japan because it's a very misunderstood problem.
That's another show, and we'll have you back to talk about Japan. But I want to thank all of you for discussing what could be an arcane topic in a very accessible way. So thank you so much to Alan Meltzer at Carnegie Mellon's Tepper School of Business in Pittsburgh, Joseph Gagnon, the Senior Fellow at the Peterson Institute for International Economics in Washington, D.C., and of course Brian Milner here in the studio, the Senior Economics Writer and Global Markets Columnist for the Globe and Mail. My thanks to all three of you.